Now I am going to use this video to run through some major plays for the past week and how should we be trading such major plays and what should we be looking out for. Now firstly, this is from Friday 22nd of July. The big play, as you can see, would be a sell-off that started here right before we started, very slow descent. So this is the Friday chop that we were talking about, but it was a really slow descent, so it's really hard to enter any trades in such slow descent. So you have to be taking your shorts from here and leave a runner all to the end of the day. Now if you can take it from here at the top, you still will have some form of retracement. There is also quite a nasty chop right here, so this would have been a good play. Now here it's also really hard, apart from the fact that this was the high of day, for you to gain any safe entry. But this, I want to talk a little bit about that. Now when we started bouncing on from the support level here, you notice we started to build a buying channel, and that's really important. I always mention to build a channel. So we see higher lows that's forming, we form a buying channel up here like this. You also notice these long top wicks here at this point, so these are also really very strong resistance in that point in time. Now I'm going to show you the replay. What's it going to look like? Now this is how it looked like at that point in time. You can identify using the wicks. Now having wicks will help you identify the key levels quite clearly. So in this case, you see when the buyers are buying at a higher price, as I always say, the volume is constant or it's reducing, you can safely assume that the buyers will be diminishing because no buyers are incentivized to buy at a higher price. However, the sellers, you notice there is some form of a supply zone here. So for the sellers, they are always selling at a constant price. So in this case, you can assume that the sellers will maintain their volume while the buyers will reduce their volume. And when this happens, guess what? There will be an imbalance and it will bring the chart downwards. Now the problem with this is that we have to be very cautious with some form of a stop hunt. Now this was the big play for today, so there will certainly be some form of stop hunting. So I want the members to look out for any additional volume, and that's actually quite important. We have to pay attention to that. Now right here, when you have such a structure, this is called an ascending wedge. It's a bearish structure. You have this ability to put in very, very clear stop losses because this is the resistance right here. So when you have a structure that can give you an opportunity to put in clear stop losses, you want to be taking the trade as close to your stop loss as possible. This would be a good fill. Now if you were to take a put here at this level, you would have to risk this amount. You will have to be red here before seeing whether this structure really holds up. It's not a good trade. So sometimes you have to be very patient to enter a trade. We see the structure, but that doesn't mean that you have to enter the trade immediately after you identify the structure. Wait for it to retrace a little bit closer to the stop loss. Now if you miss a good entry, that's fine. I rather miss a trade than to enter into a bad entry. So always remember that there's always opportunity to take the trade later again, and we will see it later. There is an opportunity that we see. So turns out, because when there is a spike in volume, it means that there may be a possible stop hunt incoming. Now look, this is a spike in volume. Now this structural imbalance is accounted for. As I mentioned, buyers buy at a higher price, sellers selling at a constant price. The sellers will prevail if the volume is constant or reducing. However, you see this volume spike right here. Now, how do you identify volume spikes like this? Now, this is where we need to take a look at our 1 minute chart. So sometimes we need a 1 minute chart open by the side. It helps you see better if you're not able to extrapolate based on a 5 minute chart. So this was where we were exactly. Now, this was the ascending wedge here. Look, it's beautiful, right? We have very clear stop loss target here. But once you see this volume increase, now the volume has been constant so far, and suddenly we have a volume increase, you know that the stop hunt is coming. Now, when this happens, how do you cope with it? Now, the first play is very simple. If you have a good entry, let's say when this candle comes right in, you notice the volume come in. Now, if you entered here near to the stop loss, now you stand a better chance to survive the stop hunt, isn't it? Because if you take a look, if you entered it as close as a stop loss target as possible, this is only a 0.3 move. 0.3 probably costs less than 20 cents per contract. It's not much. So you have to have a good entry to prevent yourself, firstly, from being stop hunted. Now, secondly, if you don't have a good entry here, right, and we went up, we came down, that's fine. Wait till you have a good entry and you see this candle coming up here. You know something is up, you don't enter. You wait for it to stop hunt before you enter again, and it will go right down. So that's another method. So the trick behind, firstly, preventing being stop hunted is to have a good entry as near as possible, and you will be able to identify such stop hunt in future as well. Now, another way to resolve this, and this is a more conservative way, is to always have secondary stop losses. So in this case, I can have my primary stop loss here. Now, what does this mean? Let's say I'm taking 2 contracts, right? Or it can be a multiple of 2, taking 4, taking 10. You set half of your stop loss at this conservative level, and you identify a secondary stop loss target here, and you can assign the rest of your contracts to stop at a higher point. Now, this is to prevent being stop hunted. When there's a major level, now you see that there is an imbalance that's being suppressed, you know that a big move is coming, or there is a major level that needs to be breached, you have to anticipate a possible stop hunt. So the way to do this is to split up your stop losses to have a primary one and a secondary one. Now, this is really helpful. This is a very helpful way to ensure that you maintain into a trade when you can sense that there is some form of big movement that's coming. Now, in this case, we've been chopping for too long and we see the suppression here, right? This structure is just completely obvious, especially in higher time frames such as the 5-minute. Now, that being said, when this happened, right, if you miss this trade, that's fine, because you notice there's always some form of retracement and flagging. And we had another similar structure here again, and this time off a major level. So this orange has turned resistance. You notice there's another wedge here that's formed. This time perfect stop loss. There's no need for a stop hunt, and then we headed straight down. So once again, same basic principles. Always take your partial profits and then leave a runner. And if you left your runner all the way to the end here, where you notice, right, we also charted our selling channels, and you notice that once it broke out of the selling channel here, it's time to close your positions, right? Or you would have lost additional 1.5 points here, right? So you would take out your positions here once this selling channel is broken, because eventually we started forming a cup and handle formation right here, but we didn't reach the neckline. Now, I would have traded this if not for power hour and being a Friday, but we can see that there is a basing formation here, especially where we started flagging near the orange for such a long time. So this is quite an obvious cup and handle formation right here, but not in power hour and not on Friday. And we will take a look at some other examples. Now, if you just started learning to trade, or you're just recovering from a very bad trading episode, the first thing you need to worry about is just your entries. Focus on getting your entries in. Don't worry about the P&L. The money, the profits will come in later once you can nail this. Now, once your entries are great, the next thing you need to worry about is to take your decisive profits. Get your profits quickly. That's what you need to do. So having decisive profits proves that your entries are good. So take quick profits. Don't be worried about your risk reward. Just take your quick decisive profits. That's all you need to worry about. Now, when you have more green days than usual, this will prove a few things to you. This will prove that firstly, you are not as bad a trader as you think you are. that you are able to trade because you focus on one thing at a time. Now, if you're just starting out, you don't want to be going straight to the ocean. You want to be starting out in the pool. This is it. So make sure that you get enough green days. Make sure that your entries are great. That's all you need to worry about. P&L, not yet. Now, secondly, once this is done, you worry about your runners. You worry about defending your trades. Now, with runners, the most important thing is that you need to defend your trade. You need to learn how to defend your trade. And when you learn how to defend your trade, it means knowing more risk management. Now, risk management is important, even for beginners. But because you're a beginner, you take decisive profits, you are reducing your risk management liabilities. You don't have to worry that much yet. So start one thing at a time. Focus on your entries. That's the most important thing as a beginner. And later on, you start focusing on runners. You take more than one contracts. You learn to defend your trade by always taking decisive profits from that one contract. And that's what you learn as a beginner. And subsequently, you worry about your runners. And when you do that, you learn more about risk management. You learn about adjusting your stops. You learn about break even. You learn about risk reward. You know how long you want your runners to be running because you understand risk reward. Now, all these must be predicated by this thing I call structure. Now, I'm going to explain more about structure in due time, but structure tells you where your entries are. So I'm going to run through structures a little bit more later when I run through today's trade. Now, trust me, when you nail these two things, when you get these two things done, and this two can be done within weeks, you can get this mastered within weeks. And once you master this, profits will come in by themselves automatically. Now, when we started yesterday's trade, especially the early candles, what do we want to be looking out for the early candles? Now, if you can avoid it, avoid trading the early candles unless you are experienced enough to know what you want to do. Now, remember, the beginners, you want to be focusing on your entries. You want to be taking 1 to 2 good trades. You will never get a good entry, never in the early candles. Now, because the market has to decide where to go. Now, take a look. Yesterday, we had such a strong rally. Now, granted, we opened in the middle of our ranges, so that's the tricky part, right? But this is a strong rally. But even a strong rally, you will have 1, 2, 3, 4, 5, almost 30 minutes of indecision. Look at all these dojis. These are indecision dojis. The market was indecisive at least for the first 30 minutes. So even in a strong green day, you're going to see indecision like this. Now, these are advanced plays, right? When you see long top wicks here, there's a certain rejection here. Now, you will know that this will be a protected supply zone, at least for the early candles. Now, if you took puts here because you knew this was protected, you put your stop loss here. Now, once again, who should take early candle trades? Not beginners, because if you're a beginner, you should be worrying about entries, and there's no way you're going to get good entries from indecision dojis like that. And if you're going to take just 1 to 2 trades a day, this is the worst place you want to be entering a trade. Don't be wasting your quality trades on setups like this. This is all over the place. So if you need to be trading early candles, you must at least know what you're trying to do, or you're very sensitive to price action. Now, because there's a quick supply zone here, because it's formed by the early top wicks, right? If you took puts here quickly, now, because these are early candles, you want to be just worried about the high and the low of day. Back at that point, let's just take a look at the first 3 candles. If you took puts here because you saw the strong rejection here, you put your stop loss here. Now, at that point in time, the lowest level was here, the bottom wicks here. So if you took puts here, you would have to close your partial profits as quickly as you can by that low of day at that point in time. Now, this will be a 1-point move. Sometimes it's good enough, so you need to know your trading objective. If you're just coming in to take some quick profits and call it a day within the first 30 minutes of the day, this would be a good trade for you. So this is called scalping. Sometimes we scalp for quick profits and call it a day quickly. So you take your quick profits here because this was the previous low of day, and because of the long bottom wicks here, you're going to be expecting some sort of buying pressure. So if you are taking puts, take your profits when the candle is still red. When the candle is still red, you know that this is where you want to take profits. When the candle reaches this part, take your profits. Now, when the candle is red and you're taking profits for puts, you will be gaining the slippage. Someone will be paying the slippage for you. But once it turns green on the reverse back up, then you're going to pay for slippage, and it is not going to be cheap. So that's one tip. If you want to be scalping, if you're taking puts, close it on the red. And if you want to be buying puts, you buy it on the green. Vice versa for calls. I'm going to explain that more in another video, so please put in the comment below if you want to know more about that. So when you see that coming, you knew there was going to be some support here, so you take your profits from your put from there very quickly. Now thereafter, you should see this 3 long bottom wicks. Now this is going to be a heavily defended zone, and then we started to never revisit this low again. Now we took a look at a 1 minute chart, and I charted this in the Discord server. We had a selling channel. It was very obvious. How do you tell the selling channel? Now always be charting channels as soon as you can so they provide some form of references for you. Now this selling channel had really long top wicks. That's what you want to be looking out for, right? Now this long top wicks just tells you that there are ready sellers at this level. Now this long bottom wicks here tells you there are ready buyers at that level. Now when this happened, we had a selling channel and we saw that it never revisited again, and we started trading up here. Now, especially when we broke through the selling channel right here, we were saying, hey, there may be a boost because this low of day was never tested. I told members always look out if we are not testing the low of day. Now we are going to break through this. So we see a possible inverse head and shoulder. Now granted, this is the 1 minute chart. Now I'm not a fan of looking at structures like this and lower time frame, but sometimes it works. We broke out the selling channel here, right? The selling did not continue. When the selling channel breaks out, there are a few things you want to note. You want to see if this selling channel continues as a bear flag to head down. Then you know the sellers will continue. But in this case, the selling channel is broken, so that's your first indicator. Now, secondly, it's forming a bullish reversal structure. In this case, that inverse head and shoulder pattern. And thirdly, you had a very clear area for you to take your stops, especially at the bottom. So here you could have taken calls with a clear stop loss at the low of day. In fact, at the shoulder line, it's possible for you to take stops as well with a secondary backup stop below at the low of day here. So you had 2 stop loss targets here, and when it broke the selling channel here, it's forming some kind of reversal pattern. This is where I would have quickly taken my calls or cut off my puts. And there we go, the rally started from there. Now once the rally started, now 5 minute chart here, we drew a buying channel and there was no turning back. Now this buying channel, we did see some flagging here, especially at orange. Now this orange, now back to 1 minute chart, this orange was where we were interested in. So if you took puts at orange here, now do note you still have a very clear stop loss. So that's a good trade if you take puts from orange, right? Take your partial profits as quickly as possible. Where do you take your partial profits? Now very simply, always take it at the previous high as much as possible. Now take a look here. The previous high was this defended level at 386 blue, right? Once we get to orange here, you took puts here and it went down. Take your partial profits here. Leave a runner. If the runner fails, take your profits. Cut it early, adjust your stops, or if you can afford to break even with that runner, let it break even. Now here it is. If your trading objective of the day was just to take this one trade of puts here, now this would have been at least a 0.5 to 0.7 move. Good enough profits if you're just starting out to trade. So this is also a possible play, but you will not be able to take this play if you do not know your trading plan. Now, if you're entering into an ocean and you have no idea what you want to catch, two things are going to happen. Firstly, you're either going to be eaten up by a whale or you're going to go home with nothing. Know your objectives. Now, this would have been the first good trade, isn't it? Even though it was not the trade of the day. That's fine. Go out with profits. Now, if you took decisive profits here, great. If you took runners where they're protected, great. You would have come out green anyway. So thereafter, you realize that there is buying channel here. So if you took your puts, took your partial profits, and you realize that the structure is not weakening, in fact it's strengthening, right? We see that by the time the second candle it bursts out of this orange, you knew you probably got stopped here, and that's fine. You already have a protected trade and you took some early profits. Now from here you can start charting a buying channel because you can see a buying trend over here, and that's what we did. Now after which the trend is your friend. Don't be calling out for a reversal until at least this buying channel is broken. And that's what we're looking out for, right? Orange 386. So if you took your first trade here from orange 386, you would have taken some decisive profits. And if not, you will be looking out for the support, especially when we had a buying channel. Now, are there opportunities to be taking calls? Absolutely. Now take a look. Lower high, lower high. Higher high, higher high. Even though we were at the orange range here, this is a clear buying channel. I would have taken calls right here when orange was being reclaimed, and when I saw this buying channel here, lower high, higher high, higher high. Buying channel here. Once we clear a major level in that case, once we base it off support here, buy your calls here. If you buy your calls here and time it like that, now, try to see what I see here. If I have a buying channel here, right? Lower high, higher high, higher high. And I have a major level that we were trying to reclaim, in this case, orange 386. I can take my calls here, isn't it? Where will my stops be? Firstly, my stop can be at this level where the buying channel is. That will be my first stop. I have a backup stop just in case, and that is the previous lower high. So I have a secondary stop here. Now these two, you see, levels here are there to protect you. So would you have caught on a call here? Yeah, you could. Now, where is your profit target if you do that? If you caught a call here, try to take your profits by the previous high. That's your first profit target, or at least at this pink. So you see, although you had some flagging here at this pink, by the time you had calls taken here and you took your profits before the green candle is rejected, you would have taken maximum profits from that slippage here. Your trade is protected. Your stops are here. You're fine. You will never be disturbed again on this trade. It will always turn green as long as you don't take 0 day to expiry. You have some leeway. You're in the money. You don't take something that's too out of the money. So all those are more advanced option strategies. I'll talk about that next time. Likewise, leave a comment if you want to see that. So if you've taken your partial profits, your remaining contracts, you're well protected. You will have continue on for the rally all the way. So you see possible good entry here. Now, as long as this channel is not broken, especially when you charted it, you should not be looking out for a reversal. Now here, right here, when this channel came to an end and we start seeing some breaking of the channel here. Now, you can see the timing. It's around 11 to 12. That's around midday. Now, when it's midday, expect some consolidation. So this flagging is actually very, very expected. Now, I'm trying to narrow down the candle so you can see it very clearly from here. Now, when the buying channel ends, it's not a reversal yet. You need to first look out on whether it is a flagging formation. Because if it's flagging and it's a bull flag, it means that buyers are still trying to gather and trying to rally. So that's really important. You need to look out for that. Now remember, I always said this. If this is an extended flagging, how do you know? You need to compare it with the size of the shaft. In this case, the size of this flag shaft. Now, this is not even half the size of this shaft yet. That's how I use a visual representation to quickly decide. So this is not an overextended flag. It's possible that it is a very good bull flag. How do you know when something's a very good bull flag? Firstly, very strong support level. So you see there's a very strong support level right here. And you see that there is a lower high in this pattern here. Now, do you see this descending wedge bull flag right here? This is the perfect bull flag. Perfect. Because you have, once again, sellers selling at a lower price. Now sellers are incentivized to sell at a higher price, remember that. So when this happens and volume is constant and you have a very strong support, which means buyers are holding this very strongly, the price action is going to hit out. So we are going to burst out again, and thereafter we formed a small buying channel. And do you see this other bull flag again? Strong support level, sellers selling at a lower price. Once again, you have another push up. Now back again to another level here, right? We have another buying channel if you want to chart it up. And then we met another heavy resistance here. Now this one is important, right? I mentioned that as long as this is not being taken, because you can chart another buying channel here. And this was the previous high. Now if this is not being taken, you cannot entertain a reversal yet. Because yesterday, the lows of the buying channel were never threatened. So there was no reversal at all yesterday. And once again, if you take a look here, strong support level, right? Look at all these candles being supported by this pink level here. Strong support levels, sellers selling at a lower price here. Now I would not have taken calls here as well. It's too close to power hour, and there isn't much reward here. We'll probably only reach another 1 point, another 1.5 point. So it's not worth the risk in power hour. So by this time here, I would have stopped trading, looking out for reversals. That would be the only trade here, but the reversal never came because it did not breach this purple 391, which was part of the buying structure and also previous highs that was never breached. But hey, if your objective, especially at a major level, now take a look at this point in time when you see this green candle here. If your objective is just to take quick profits, right, you can set your stops here, no problem. Right, and when the red candles come in, you take your quick profits by the next level. Now this would also still be at least a 0.8 point move. You would have taken 0.8 points of profit if you've taken your trade from a major level. If you left it to run till the next level here, which we were looking out for, this would have been a 1.3 point trade. You would still have taken good profits, at least a few $100s here if you took 2 to 3 contracts. Still a good trade. So if you knew your purpose, if you knew your structure, if you knew your stops, if you knew your entry, if you knew your profit targets, and if you are able to counter slippage by having the finesse to be taking maximum profits when the candles reach your profit target instead of just hoping and waiting, this would have still been a good trade, a few $100s here even. So this is what I mean by going into a trading day knowing your purpose and objective. Now, a good trader will never maximize 100% of his trade. I can tell you that, never. I've never maximized 100% on my trade because my objective is to protect the trade as early as possible. I would always at least take 50% of my trade value to protect my trade 100% of the time. Now that's worth so much more than risking 100% of my capital to try to double or triple it. It's just not worth it. I would take 50% of my capital, protect the trade completely so that I will never lose, and I'll let the remaining 50% of that capital do the work of getting the profits for me. So that's a really long video. So thank you very much for watching, and I'll see you closer to opening bell.